Welcome to Breaking News to Trading Moves. Imagine you are running a business where your absolute biggest daily operating expense drops by 10% overnight.
Right, which is pretty much the dream scenario for any operator.
Exactly. And here's the catch. You don't have to lower your prices for your customers. Your profit margin simply expands the very moment you open your doors the next morning.
You just keep the difference.
Yeah, you just keep the difference. Today, we are analyzing a specific geopolitical headline that is making that exact scenario a reality for a select group of companies while, pulling the rug out from under others.
The headline driving this action right now comes from the Middle East. Iranian negotiators have stated that progress has been made in peace talks with the United States.
Okay, so a diplomatic update.
Exactly. And in direct response to that development, we are seeing Brent crude oil prices ease. The market is currently removing a portion of the risk premium that is specifically linked to the Strait of Hormuz.
Right, because that's a major transit choke point.
Yeah, it is. So when the perceived threat to that choke point lowers, the immediate price of a physical barrel of crude drops in tandem.
Our mission for you today is highly focused. We are asking one central question. Who are the financial winners when an oil shock fades? And who loses momentum if the geopolitical fear trade unwinds?
And we really need to stick to the data here.
Absolutely. We are going to strictly analyze the sectors and specific companies impacted by this exact headline. To be perfectly clear right from the start, we are keeping this entirely calm and analytical.
I mean, we're not suggesting this single diplomatic headline alters the entire global market, right?
No, not at all. We are not saying it changes the broader economic landscape. We are strictly tying our discussion to the provided facts regarding these localized sectors.
Because market reactions to these types of geopolitical headlines, they are driven entirely by probabilities, not certainties. Traders are just constantly adjusting their mathematical models.
They are reacting to the likelihood of a supply disruption.
Right. Right now, they are pricing in a marginally lower probability of a disrupted oil supply. That adjustment creates very localized, measurable momentum in specific industries.
Well, let's begin with the clearest beneficiaries in this scenario, which would be airlines and leisure travel. The mechanics here operate almost instantly.
Yeah, they really do. Jet fuel is reliably one of the largest, if not the absolute largest, operating expenses for any commercial carrier.
And airline ticket prices are generally purchased by travelers months in advance, right? So a sudden drop in fuel costs doesn't immediately lower the price of a ticket for the consumer who is currently sitting in the terminal.
Exactly. Instead, that savings drops straight to the bottom line of the airline. Lower oil improves profit margins immediately, provided passenger demand remains firm.
So it comes down to what we call operating leverage.
Yes, operating leverage. The cost of purchasing the aircraft, paying the flight crew, leasing the airport gates. Those expenses are mostly fixed. The airline has to pay them regardless of what happens in the news.
They pay the same amount for the gate whether crude is up or down.
Right. The jet fuel is the massive variable cost that swings wildly based on global events. When that variable cost drops due to easing geopolitical tension, the financial profile of the flight improves while the plane is literally in the air.
I always compare jet fuel cost to a toll on a highway. Imagine you run a long-haul trucking business. Your trucks are full of paying customers, your road is set, and the contracts are signed.
Okay, I like that analogy.
If the toll on that specific highway suddenly drops by 20% overnight, your journey immediately becomes more profitable. You don't pull over and refund the passengers in the back of the truck,
No, you definitely don't.
You simply keep more of the revenue you already collected.
That visual captures the mechanic perfectly. The carriers don't rewrite the financial rules, they just benefit from the widened gap between their fixed revenue and their newly lowered variable costs.
So when we look at the specific airline beneficiaries, we kind of have to divide them by their route structures. Let's analyze the international carriers first.
We're looking at DAL, Delta Airlines, and UAL, United Airlines.
Why does flying internationally make these specific companies more sensitive to a drop in Brent crude?
Well, it's a matter of sheer scale, distance, and fuel capacity. I mean, international flights are long-haul routes crossing oceans.
Right.
The aircraft required for these routes are massive, and they carry staggering amounts of jet fuel. The total physical volume of fuel burned on a flight from New York to London is vastly larger than a quick flight from New York to Boston.
So a small percentage drop in the cost per gallon of jet fuel results in a much larger absolute dollar saving.
Exactly. It's a massive dollar savings for a carrier that is heavily weighted toward those international routes.
Adding to that, we also have the domestic side of the industry to consider. The tickers we are watching there are AAL, American Airlines, and LUV, Southwest Airlines.
And their situation is slightly different, but still highly relevant.
Yeah, even without the heavy international weighting, their sheer volume of daily domestic flights means that fuel cost relief provides an immediate financial lift.
Because they operate in a highly competitive domestic space with notoriously tight margins. Any relief on the cost side is instantly accretive to their earnings.
And by accretive, we simply mean it adds directly to their projected profits without them having to sell a single extra ticket.
That volume is key. A carrier like LUV, Southwest Airlines, relies on rapid turnaround times and high-frequency short routes.
Right, they're constantly taking off and landing.
Yeah. So while each plane carries less fuel than a massive international jet, multiplying a small fuel saving across thousands of daily domestic flights creates a highly measurable boost to their quarterly earnings projections.
So the logic holds up clearly for the sky. Let's analyze how this dynamic translates to the sea. The mechanism should be nearly identical for the cruise line industry, shouldn't it?
It is. The mechanics of operating a modern cruise ship are completely reliant on fuel consumption. These ships are essentially floating, self-contained cities.
They really are. They generate their own power for thousands of guest rooms.
Right. They run massive hotel operations, restaurants, and entertainment venues, all while operating massive marine propulsion systems. The fuel they burn to manage all of that flows directly into their operating margins.
The specific companies we are watching in this space are CCL, Carnival, RCL, Royal Caribbean, and NCLH, Norwegian Cruise Line.
So when institutional investors see Middle East tensions cooling, sentiment around these names strengthens because their operational overhead is projected to fall.
But there is a secondary catalyst here that makes the cruise lines particularly compelling in this scenario, isn't there? Lower oil doesn't just reduce the cost of running the ship.
No, it reduces broader inflation pressure across the entire economy. And that secondary factor is vital to the leisure travel thesis.
Right, because when crude oil drops, the cost to transport goods drops, which eases general inflation.
Exactly. When everyday inflation cools, the average consumer feels less pressure on their monthly household budget.
And companies like CCL, Carnival, or RCL, Royal Caribbean, rely entirely on discretionary travel demand remaining resilient.
Yeah, if families are spending less capital to fill up their personal vehicles at the local gas station, or paying less for groceries because freight costs dropped, they have more disposable income available.
More money to book a cabin on a cruise ship.
Precisely. It functions as a double benefit. The company pays less to operate the vessel, and the consumer simultaneously has more money in their pocket to purchase the ticket.
That dual mechanism is exactly why leisure travel often catches a bid from traders when energy prices cool.
The mathematical models run by major investment firms instantly recalculate the probability of both margin expansion for the company and sustained discretionary demand from the consumer.
Let's move the conversation from moving passengers to moving packages. We are looking at logistics, delivery, and large retailers.
These are the direct beneficiaries of lowered transit costs.
We are analyzing massive transport and distribution networks with absolute, non-negotiable exposure to fuel costs across both air and ground delivery.
The major players defining this space are FDX, FedEx, and UPS United Parcel Service. Just consider the physical scale of their daily operations.
It's massive. They manage tens of thousands of local delivery trucks.
And massive fleets of long-haul tractor trailers and vast networks of cargo aircraft. Fuel is an inescapable daily reality for their business models.
So when the price of crude falls, the cost to move every single parcel through their network drops.
Yeah, every single one.
Now, I want to clarify something about the delivery sector. Companies like FDX, FedEx, and UPS, United Parcel Service, use fuel surcharges, right? They pass a lot of the fuel cost directly onto the customer shipping the package.
They do, yes.
So if they are passing the cost along anyway, why does a drop in base fuel prices actually help their stock?
That is a crucial distinction. While they do utilize fuel surcharges to insulate themselves from price spikes, a lower base cost of fuel gives them crucial pricing power and operational flexibility.
I see.
Well, if fuel drops, they can choose to lower their surcharges slightly, making their delivery services more attractive to massive e-commerce clients compared to competitors.
Oh, I see. Or they could just keep the surcharge the same.
Exactly. If they keep surcharges relatively stable while their actual underlying fuel cost drops, they capture a wider profit margin on millions of daily deliveries.
So lower input costs always provide a logistical advantage, regardless of the surcharge model.
Always.
That perfectly bridges us to the companies that don't just deliver the goods, but actually sell them. The massive retailers are the indirect beneficiaries of this headline.
Because they rely entirely on these sprawling logistics systems.
All right, even if a retailer does not own the delivery truck dropping the package at your door, they are paying for the freight. When the cost of freight drops, the cost of goods sold drops.
The prime examples to watch here are AMZN, Amazon, and WMT Walmart. Both of these corporations operate supply chains of staggering size.
AMZN, Amazon, runs a vast fulfillment network with thousands of branded vans and leased cargo planes.
And WMT, Walmart, operates one of the largest private truck fleets in the entire world. The direct impact of lower oil for them is lower input costs across the board.
It just requires less capital to get a product from an overseas port to a regional warehouse.
And from the warehouse to a local store shelf or directly to a customer's front porch.
And we find ourselves right back at that consumer budget dynamic we talked about earlier. Cheaper oil means less pressure on household budgets, freeing up retail spending.
Yeah, if you save $20 on your weekly commute, you might add an extra item to your digital cart at AMZN Amazon.
Or pick up a discretionary item while walking the aisles at WMT Walmart.
And while $20 sounds minor on an individual level, when you multiply that behavioral change across hundreds of millions of global consumers, the revenue impact for these massive retailers is highly measurable.
So the market prices that anticipated retail revenue bump into the stock almost immediately. But, every financial action has a reaction. The exact same dropped dollar that makes the airline ticket more profitable and the freight delivery cheaper is a dollar that vanishes directly from the balance sheet of the companies pulling that oil out of the ground.
Yes, the other side of the trade.
Let's analyze that side. Who loses momentum when peace talks progress?
The most obvious losers when crude falls are the oil producers themselves. We are analyzing the integrated oil majors and the major shale producers.
Because these corporations generate revenue based heavily on the spot price of crude.
Right, the actual current market price of the physical barrel.
The specific tickers in focus here are XOM, ExxonMobil, CVX, Chevron, COP, ConocoPhillips, and OXY, Occidental Petroleum.
These producers benefit directly when geopolitical tension adds a risk premium to barrels of oil. That risk premium acts essentially as extra unearned margin for them.
Unearned margin.
Yeah, it is price appreciation driven purely by the fear of a future shortage rather than a current physical lack of supply.
So when Iranian negotiators announce progress in peace talks, making a sudden supply shock look less likely, traders remove that fear premium from the current price.
That's it.
Let me make sure I am phrasing this correctly for you. The actual physical amount of oil sitting in storage tanks around the world did not change today.
Not at all.
But the fear of what might happen tomorrow changed. And that psychological adjustment pulls the current price down, instantly hitting the valuation of XOM, ExxonMobil, and CVX Chevron.
That is the exact mechanism. Traders constantly evaluate the mathematical probability of a disruption in a choke point like the Strait of Hormuz.
And when that probability drops, the premium evaporates.
Right, and the projected future earnings for the producers are revised downward.
I want to push back on the mechanics of this, though. Does a drop in crude prices today actually stop a company from drilling a well right now? Or is this just traders overreacting to news alerts on their screens?
Well, that brings us to a vital subsector: oilfield services and drilling suppliers. You are right. A headline today does not stop a physical drill bit that is currently turning in the ground in Texas or the North Sea.
Okay, so operations continue.
Yes, but the stock market is entirely forward-looking. It operates on capital spending plans, often referred to as capital expenditures or CapEx.
So CapEx is essentially the forward-looking budget that an energy company sets aside for future drilling and infrastructure projects.
Exactly right. When crude weakens, investors immediately start questioning future drilling and production spending.
Because they have to plan ahead.
Right. An oil producer plans their CapEx budget based on what they project oil will be worth next year or 3 years from now. If the price drops today and looks like it will stay lower because geopolitical risks are actively cooling, those producers become financially cautious.
They might decide to delay a new offshore drilling project or reduce their onshore rig count to protect their cash flow.
Yeah, exactly.
And if the producers delay the project, The companies that provide the equipment, the technology, and the crews lose out on that future revenue.
That's the downstream effect.
The tickers we are watching for that specific downstream effect are SLB, SLB, HAL, Halliburton, BKR, Baker Hughes, and NOV.
Those service companies are entirely tethered to the capital spending plans of the energy producers. They do not sell the physical oil.
They sell the specialized services required to extract it.
Right. If lower oil prices make the producers more cautious with their budgets, the demand for well construction, pressure pumping, and field services looks far less attractive.
So while a diplomatic headline today doesn't halt a current operation, it alters the financial modeling for future operations.
Which directly hits the valuation of companies like HAL, Halliburton, and SLB.
The concept of a risk premium isn't just priced into barrels of oil, though. It is also heavily priced into global security sentiment. Let's look at the defense sector and the mechanics of geopolitical risk stocks.
Analyzing defense requires a crucial nuance. Defense stocks do not move strictly on one single diplomatic headline.
Because their business models rely on massive multi-year government contracts.
Exactly. A single diplomatic meeting regarding the Middle East does not cancel a decade-long procurement program for advanced fighter jets, missile defense systems, or naval submarines.
Okay, so if the underlying revenue from those massive government contracts remains stable, why do the stock prices drop when tensions ease?
It comes down to valuation multiples. The premium investors are willing to pay for $1 of the company's earnings.
Oh, okay.
When global conflict risk rises rapidly, investors flock to defense stocks as a safe haven. They assume that heightened global tensions will inevitably lead to increased defense budgets from various governments down the line.
That sentiment creates buying momentum, pushing the valuation multiples higher. The market pays more for the stock simply because of the perceived safety and the anticipation of future conflict-driven spending.
Right. The specific companies heavily watched in this scenario are LMT, Lockheed Martin, NOC, Northrop Grumman, RTX, and GD, General Dynamics.
So if institutional investors believe the immediate risk of a wider U.S.-Iran confrontation is falling, the momentum in those specific names cools rapidly.
Yeah, the underlying business remains incredibly stable, but the extra premium that traders assign to the stock based on immediate conflict fear gets priced out.
It functions as a rotation. Capital moves away from defense as a hedge and flows back toward more growth-oriented or consumer-driven sectors that benefit from lower inflation.
It is a fascinating financial ecosystem to analyze. Capital rarely just vanishes from the market, it rotates.
As the fear premium drains out of the energy sector and the defense sector, that exact same capital flows into airlines, cruise ships, and logistics networks.
That is the overarching theme traders are monitoring here. Markets are constantly repricing risk. If the U.S.-Iran talks continue to progress constructively, traders may look for a continued strength and margin expansion in airlines, cruise lines, logistics, and consumer-linked retail names.
While simultaneously, oil producers, oil field service providers, and defense stocks may lose the premium built on that specific geopolitical tension. But we must remind everyone listening that this is never a clean one-way setup. You cannot trade a single headline in a vacuum.
Absolutely not. The risk of a supply disruption in the Strait of Hormuz has not completely disappeared.
Right. Diplomatic progress is notoriously fragile and subject to instant reversals. Furthermore, the Federal Reserve rate outlook remains a persistent pressure point for all equities.
Even if oil drops, if the broader interest rate environment remains highly restrictive, consumer spending might not rebound exactly as the retail and cruise line models predict.
That broader context is vital. Traders have to monitor crude oil pricing daily, watch the reaction in energy stocks, and check for sustained airline strength.
And most importantly, wait and see whether this capital rotation actually gains confirmation over multiple trading sessions rather than just a one-day knee-jerk reaction.
Before we wrap up our analysis, I want to leave you with a final thought to ponder. We've spent this time discussing the mechanics of how quickly capital rotates when geopolitical tension cools.
But consider the exact inverse scenario.
Exactly. If the geopolitical risk premium were to return abruptly tomorrow, if negotiations suddenly stall or a new flashpoint emerges in the region, how quickly could the momentum in these specific travel, retail, and logistics trades violently reverse?
Something to think about.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.